This is going to be one of the more highly watched Fed meetings in quite some time. They're all highly watched. They're all highly analyzed. But this one, I think there's a bit more uncertainty that we're seeing in advance of the Fed meeting than we have seen in many prior ones. There was, at one point, more or less a deadlock certainty that the Fed was going to raise interest rates 25 basis points and that they were going to continue on their raising path throughout 2019. That's really changed somewhat. We're now seeing a likelihood of about 70% of a Fed rate hike at the Wednesday Fed meeting. And now there's a lot more uncertainty as what they might do in 2019. The market's sort of looking for between 1 and 2 rate hikes, despite the Fed, quote, dot plot showing somewhere closer to 3. So there's a lot riding on this meeting, and even more so considering the very poor response that the stock markets have had. Most markets, virtually all financial markets, have had through the month of December. So what should we be expecting? One of the better comments I'd heard, and I wish I could take credit for it, was a dovish hike. Someone used that term on the radio this morning, and I like it. The dovish hike would mean that they're hiking the interest rates now, which again is showing about a 70% probability. And then they make dovish noises through 2019. I think that would fit in very well with the market consensus. Markets don't like to be surprised. So although you might say, well, the market's discounting this already and the market acts horribly, well, I think it may be somewhat assuaged by the fact that if the market kind of gets what it wants, that would be a helpful sign. Another thought that comes into play here is something we really haven't seen much of a historical precedent for, and that is the president so aggressively jawboning the Fed in the days leading up to a Fed meeting. That is a total wild card here. The consensus, and my view as well, is that Mr. Powell is probably more likely to raise rates because of the jawboning, sort of to show some resolve, to say, well, you know what, you can talk all you want, but the Fed is independent, and this is our way of showing it. And then I guess the way around it would be the dovish statement going into 2019. There's certainly signs of slowing economy that we're seeing throughout the financial markets. Oil, West Texas has broken, substantially through $50. The rates on Treasury bonds have had a substantial decline, which partly reflects lowered inflationary expectations, and thus, therefore, a weakened economy. So the economic signs from the market are not all that great. So that's probably how I see it here. So how would you play it? I think if you really feel that the markets are oversold, it's probably a good opportunity to be looking for some names that you've liked. I don't necessarily love the markets as a whole, but I do think there's some names out there that have really been beaten up. Compliance won't like it if I mention too many things that I like, so I can't really make recommendations. But just what I would say is when you see a market as we've had, there are a lot of bargains to be had, and I think one man's bargain can be the result of someone else saying, "Get me out," and I think that's something you should be looking for going into the Fed meeting. Now, if the Fed comes out and surprises in one direction or another, that can bode very poorly. I think if the Fed seems resolute about three interest rate hikes or even more in 2019, the stock market won't like that. Although there's some people who would say, well, if the Fed doesn't do anything, the markets will worry because, what do they know that we don't know? I don't really buy into that. Although I do think you raise the specter of higher volatility going forward, because I think the markets won't, in the long run, like the idea of a Fed that can be jawboned by a president. So that's hopefully a little bit of a playbook, and happy trading.